Good morning. This is Cassandra. Can you hear me?
Yes, ma'am, we can hear you.
Wonderful. Thank you.
Yes, ma'am, we can hear you.
Thank you. I'm just trying to check out my video.
Good morning.
Good morning. This is Cassandra. Can you see my my camera or my picture?
Good morning.
Good morning. We are going to call the Fire Department Pension Board to order at 10:04. First item on the agenda is the swearing of the new board members. Swearing Mark Lenny back in and swearing in the new member, Alec Dowell.
Sonny, the interim city clerk will be doing the swearing in right now.
Yes, ma'am.
Mr. Dowell, if you come forward to the microphone. And I'm going to ask you to raise your right hand. If you'd like, put the left hand on your Bible. I, Alec Dowell,
I, Alec Dowell,
do solemnly swear or affirm
do solemnly swear or affirm
that I will support, protect, and defend the Constitution
that I will support, protect, and defend the Constitution
and the government of the United States
and the government of the United States
and of the state of Florida
and the charter and ordinances of the city of Palatka,
that I am duly qualified to hold office
under the Constitution of the state,
under the Constitution of the state,
and that I will well and faithfully
and that I will well and faithfully perform the duties of Firefighters Pension Board member on which I am about to enter. So help me God.
Welcome aboard, Mr. Dowell.
Thank you very much.
Mr. Mark Lenny, if you would, raise your right hand, and if you'd like, put your left on the Bible. I, Mark Lenny,
I, Mark Lenny,
do solemnly swear
do solemnly swear or affirm
that I will support, protect,
that I will support, protect, and defend the Constitution
and the government of the United States
and the state of Florida
and the charter and ordinances of the city of Palatka,
and the charter and ordinances of the city of Palatka,
that I am duly qualified to hold office
that I am duly qualified to hold office
under the Constitution of the state,
under the Constitution of the state,
and that I will well and faithfully
perform the duties of firefighter pension board member
in which I'm about to enter.
so help me God.
So help me God.
Welcome aboard, Mr. Lenny.
Thank you.
Roll call, we have Myers,
Dow,
Mark Lenity,
Art Leary,
yes, ma'am. All right, the next item. Do I need to hang on a second? Okay, roll call's done. Next item on agenda is the approval of minutes. Did everybody have a chance to review the minutes?
I make motion to approve.
Motion to approve the minutes by Lenity,
second.
second by Mr. Leary. All in favor?
Aye.
Aye.
Passed. Next item on the agenda is Foster's and Foster's valuation report for 2020.
All right, can everybody see me and hear me okay?
Yes, sir.
All right, I'm gonna try to share my screen. Can you guys see my valuation report? Oh, wait. Can you see my valuation report up there?
Yes, sir.
So as you guys know, every year as of October 1st, we look at the assets in the pension plan, and then we project out all the future retirement benefits, and we determine an appropriate funding requirement for the next year. And we always do it 1 year ahead so that the city can budget. And so if you look here, October 1, 2019 is that right-hand column. And that determined the funding requirements for the year that we're in right now. And then the left-hand column determines the funding requirements for next year. And you can see there was a slight increase in the funding requirements, but pretty neutral overall. The total required went from 51.7% of payroll to 52.7% of payroll. After you take away the members and the state, the city goes from about 40.4 to about 41.4% of payroll. And there's lots of different reasons for that we'll talk about in the report. But I usually start by talking about the investment return because that's probably the most significant. And so we've always used a 4-year smoothing technique with the assets. And because we don't want the city's cost to go way up and way down each year. So we want to spread out, any investment gains or losses each year. And the method that we've been using is every year we take the prior year actuarial value and we roll it forward as if it got the actual 4-year average return. So you can see in 2020, you got 8.88%. which is a great thing during the pandemic. Your assumption was 7.6 and we got 8.88. So that's a very positive thing. But when in 2019, we had below our expectation. So the 4-year average was 7.75, which was a very slight actuarial gain on the investment side. We made one change in this report, well, a few changes, but one of the changes is that we're going to start over the smoothing technique. And the new smoothing technique is going to be 5 years instead of 4. And then each year, if we get a gain or a loss, let's say this year we get a gain of $500,000 over what we expected. Well, we're just going to recognize 100,000 of that each of the next 5 years. So we're not going to use the rolling 4-year average anymore. We're just going to spread out our gains and losses over 5 years. So mathematically, it works a little bit better, and it's a 5-year smooth. So we're recommending doing that for all of our clients. So that's what I did in this report. So now you don't have to worry about that 3.77% in 2019. Now that's not going to hurt you because we're starting over and any gains and losses in the future are going to be spread out. Here, I just noticed this is a new page that we have in this report this year. And it shows a history of the asset values and the asset returns. And so you can see that 10/1/2010, your market value of assets was about $5.5 million. And now you have, well over $8 million. So you've had a nice improvement in your assets over the past 10 years. And then at the bottom of the page, you can see the market returns are in blue, and then the smoothed returns there are in green. So the smoothing technique definitely helps. And you can see that on the top of the page too. So turnover is always an issue that makes a difference. And sadly, being an actuary, usually everything that's good for everybody else is bad for the pension plan and vice versa. So this year you had 23 non-drop firefighters at the beginning of the year, and you actually had 6 of them terminate during the year non-retirement, which is more than we normally expect. And so that was probably bad for the department, but it was good for the pension plan. That gave us an actuarial gain on our turnover. And then you hired 4 new firefighters. So you actually ended up going from 23 to 21 non-drop firefighters. And that kind of hurts the plan a little bit because your payroll goes down and then your unfunded actuarial accrued liability payment, your mortgage payment now looks like a larger percentage of payroll. So that kind of had the opposite effect. At the bottom of the page, you did have 1 beneficiary pass away. You remember the city has to put a liability on their balance sheet for the pension plan, and that's called the net pension liability. And that actually got a little bit better between 10/1/19 and 10/1/2020. Last year, they had to book a net pension liability of $3,137,000. And this year it's $2,928,000. So it went down, about $200,000, which is a good thing. And if you look at that as a funded ratio, you went from 71.2% to 74.2% funded ratio. And most plans try to be in that 80 to 100%. So you moved, a good step closer to that during the last year. And part of that is because the GASB, the net pension liability, just uses the market value of assets. And that got to use that 8.88% return rather than the smooth 7.75. Here's the other new page we put in the report, which is page 18. And that shows a history of your funded ratio. And that's been hanging around real similar rates since 2010. You were at about 81% in 2010, and you're at about 76% in 2020. So here's your unfunded actuarial accrued liability, and this is kind of like the net pension liability, but it uses that 4-year smoothing of the assets, and it does a slightly different method on the liabilities. So last year, your unfunded actuarial accrued liability was $2,920,000, and then we make a payment each year to pay that down, so we expected it to go to $2,758,000, and in the end, it was $2,693,000. So you had a nice little improvement there. And really it was the actuarial experience during the year that helped. And so your investment return, remember using the 4-year smoothing, was just a very slight gain, 12,000. Salary increases were a loss. And then that turnover was the big gain, the fact that 6 people terminated non-retirement. So you had a net actuarial gain for the year of 316,000. And then the assumption and method changes was a loss of 251,000. So there was 3 changes to the assumptions and methods, one of which we already talked about, and that was fresh starting the smoothing technique. The second one is that you guys approved a step down gradually from 8% down to 7.5% at 10 basis points a year. So this is the last year in that process. So we're changing from 7.6% assumption to 7.5% assumption. And that, increases the liabilities. But it gives you a more appropriate expectation for the future. And then the last thing is that the state mandated several years ago that all plans have to use the same assumption as FRS for mortality. And that actually helped you a little bit this year. It reduced the liabilities a little bit. And then the new table that FRS is using is actually a public employee table. So it's a big study of public employees, police, fire, general employees. So it's probably more appropriate anyway to use that. So when you use all those assumption and method changes, that had a slight increase in the funding requirements this year. So those were kind of the highlights that I wanted to go over, but I'd be happy to answer any questions anyone has.
Hey, Patrick, it's Burgess.
Hey, Burgess.
Hey, with a 11% experience from the fourth quarter, you're quick with numbers. How much would that snapshot have increased the funding ratio by? Would it be close to 80%? That's just one quarter.
Yeah, so the traditional funded ratio on page 10 looks at the actuarial accrued liability as of 10/1/2020 and compares that with the actuarial value of assets at 10/1/2020. So we had 11.1 million accrued liability and 8.4 million assets. And so if you say we got an 11% return, our assets, instead of being 8.4 million, might be
So now it was 9.2 million at the end of 12/31.
okay, so 9.2 million. And if our liabilities grew just a little bit, they might be 11,268,000, let's say. 9.2 million.
Yes.
Yeah, that'd be about 81.6% funded ratio. If we were to take a rough snapshot at 1/1/2021.
Thank you.
Yeah, if you can just do that, the other 3 quarters, we'd probably be at almost 100%.
Questions?
I was just going to point out one thing on the the last time we did an experience study was in 2016. We used the data from 96 to 2015. And, you know, in an experience study, we look at all of your actual experience for turnover, salary increases, when people are retiring, your investment returns. And then we make recommendations to change those assumptions. And then we show you what those changes would do to the funding requirements and the funded ratio. So most people out there recommend you do an experience study about once every 5 years. So this summer would be the time. It'll be 5 years after we did the last one. And, you know, the investment return, I think as a result of that study, last time you guys went from 8% down to 7.5% over a 5-year period. And now we're at 7.5%. And so Florida retirement system, they just went to 7.0. So a lot of boards are still trying to continue that reduction in the interest rate assumption. So the experience study would show you what if we changed it to 7.4 or 7.25 or 7%, what that would do. So I would just ask the board to consider authorizing an experience study over the summer. Our minimum fee for that is $7,500, so that's what I would charge.
Discussion?
But regardless of that, the board can, you know, separately approve the valuation report. That way it'll be official for the city and I'll send it to the state.
Brent, do we have time to think about that a little more and maybe, you know?
Yeah, the experience study, you guys could think about and put that on the agenda to discuss at the next meeting. But the valuation report, you should take care of today.
Yeah, we definitely have to approve the evaluation report, but we can discuss the experience study or move it, actually table it to the next meeting if need be. Any other discussion or questions on the evaluation report?
I make motion to accept the evaluation report.
Motion made to accept the evaluation report from Fosters and Fosters by Lenity.
Second.
Second by Mr. Leary. All in favor?
Aye.
Aye. Motion passed to accept the report from Fosters and Fosters.
All right, well, I'll stick around in case anything else comes up.
Next on the agenda is, oh, I'm sorry. Okay,
I second that motion as well.
second by Dowell. All right, thank you. Next on the agenda is Capital City Trust.
Good morning. Can everybody hear me?
Yes, sir.
Okay. Let's see, Jill, were you going to put up a report? If not, I can just, if you have the report in front of you, I can walk through it.
We are following along on a paper copy, so when you go through, if you wouldn't mind telling us what page you're on, it
Yeah,
speed us.
the pages are numbered. Okay, so this copy in front of you that has the blue stripe on it. On page 2 on the inside, it says policy review. This is the asset allocation review. So if we're there, pardon?
Do I have the right report up? Can you see it?
Hold on. Not yet. I cannot see it. I don't think I had the right screen option. I cannot see it.
I don't see a report either, Miss Jill.
So I can walk through it.
Excuse me, gentlemen.
Yes.
Hi, this is Valeria Thomas, the city attorney. I just noticed that Mr. Leary seconded a motion for the acceptance of the valuation report. Mr. Leary's term expired at the end of January. He has not been approved again by the board to be a member. So.
Yes, ma'am. We went back and Mr. Dowell, we changed that. Mr. Dowell seconded it and we approved it.
All right, great. Thank you.
Yes, ma'am.
I can see it now. All right, you ready? So on the policy review, let's just go over how the plan is structured. This is the fourth quarter report, but this is as of March 1st, this policy review. And so as we have been in the past, we're still overweighted large cap US equities by quite a bit. And that's at the expense of being underweighted in the other asset classes or asset segments, except for fixed income, which is neutral. So we're underweight in international mid cap, small cap infrastructure and convertible bonds. And because US large cap companies tend to be more predictable and more consistent, I've done this because I want to keep the consistency and predictability high to ensure that we get solid returns year after year. Now, recently, international has caught up a little bit with US. I'm aware of that. A lot of that has been due to a weaker US currency, which has started to reverse. Even though the currency was weak, international was not able to greatly exceed the US. In fact, I think it was about equal. And this year they're about equal. So I'm aware that the currency is causing a difference that we haven't seen in a while, but its currency is hard to predict. And I'm still in favor of the US dollar as being a strong currency over time. So for the foreseeable future, I will be still a little bit overweight in US and looking to buy on pullbacks. In fact, a couple of weeks ago, when technology stocks pulled back and pulled the S&P 500 down, I invested 1% of the fund on that dip. And so that so far has worked out. So any questions on the asset policy review? If not, we can go on to the next page in account performance, which is page 4. Bottom, there we go. So this is as of 12/31. And so for the latest quarter, which was the fourth quarter, a good quarter because of low interest rates and the fact that the election was over and the uncertainty about the election went away and the economy had begun to recover at a little bit quicker pace. People could see the vaccine coming on the way. Optimism seemed to get better and money started to flow in to the stock market at a nice pace, especially since fourth quarter earnings were good. And so the fourth quarter for the total fund was 15.4%. Equities was 16.3, outperforming the S&P 500. Bonds, especially convertible bonds, did well, returning 14.2. These are the bonds that we manage on our side. And then real estate started to recover in the fourth quarter, 9.23%, because of favorable business conditions, businesses starting to reopen and pay their rent again. So real estate is again doing its job. For the last 1 year, calendar year, the fund earned 18.8% total, 18% on equity, which was outperformed our global equity benchmark, 32% on the bonds, largely driven by convertible bonds, which were benefited from low interest rates and recovering financial sector, because a lot of convertible bonds are issued by insurance companies and banks. And then, of course, real estate for the year was down because businesses were hurt and not able to continue their rent or expand their business. So fourth quarter was a good quarter, especially equity on a relative basis versus the S&P 500, which is always a difficult bogey to meet. Some of that was driven by mid-cap and small-cap stocks, which tend to do well when an economy recovers. And of course, cash is paying next to nothing. So I try and keep cash to a minimum and use it to buy on dips. So if there's no questions on the fourth quarter returns, we can go on to page 5, which is January's returns through January. Just put that in there. January was not a great month for stocks. It pulled back due to some uncertainties in interest rates and a few other things. But the fund equity was only down minus 0.21, and it has recovered strongly since then. Bonds were up 1.2, and real estate broke even. So January was sort of a tread water type month, and then February and March have been terrific so far. As you know, economy is starting to reopen, and people are getting the vaccine. Even this morning, airline and theater stocks are way up. So things are getting better. Any questions so far? If not, you can go on to the next page, page 7, asset allocation. So this is just a snapshot of the account as of March, I believe, 1st. And this does not include the infrastructure, but we're at 58.49% equity, which is a moderate growth portfolio, 35% fixed income, 3.3 in cash, 2.7 in real estate. And I'm close, but I'm not hitting the ceiling on equities. I'm aware that I'm probably 2% away from it. So I'm aware that when I get there, I usually sell off and go back to cash for a little bit. So because of the recent pullback due to rising interest rates, I did not have to sell equities down. It brought it down on its own. So thank goodness for that. Yes.
Dwayne, I have a question. This slide does not include the infrastructure?
No, it does not.
So you have it adding up to 100%, but the infrastructure is an equity. So those,
Right.
So that slide is really a little bit off, right? Because
It's off. It's off because
Okay,
it's
but I mean-
it's my system that reflects what's in my custody. So yeah, equity would be about 6. If you counted infrastructure as equity, which people do, it would be about 61.
Can you, given the different products that you're using here, can you give some color on the products themselves? A lot of them are indexes, but do you have a sense of what's driving the performance of these options or products that you're utilizing?
Sure. Well, historically, it's rare that interest rates are zero, but in general, for the equities in the plan, the zero interest rate environment has driven cash off the sidelines and into riskier assets, one of which is equities, and especially smaller companies that were hit hard during the recession have snapped back terrific because they were undervalued. So a lot of money has flown into equities, especially small and mid cap. And those companies are growth oriented and the market is looking for growth. And because the value side of the equation, which is normally represented by banks and insurance companies, they were hurt by low interest rates. So value has been somewhat out of favor until as of late. So the mid cap and the small cap and the S&P 500 contain a lot of growth companies that tend to be technology oriented, and that has helped quite a bit. Convertible bonds were helped because of low interest rates, because when interest rates go down, as you know, bonds go up. And a lot of those bonds were down because they represented financial institutions that were hurt by the COVID. So it was more of a rebound in convertible bonds than anything. High yield, because yield spreads are tight. There was not as much value in high yield as there normally is during a recession. And so high yield did okay, 5%, but it did not do as well as it normally does. International, like I said, was benefited from a lower currency, but also the fact that China has regulated some of their larger companies like Alibaba, and emerging markets have not done as well as we would have hoped. And the international markets are not represented by fast-growing technology companies like the US is. There's a lot of pharmaceutical companies and financial institutions that tend to drive that. And so Europe did not do as well as we would have had hoped in 2020. Does that answer your question?
That's fine. Thank you.
Okay. So the rest of the report is a snapshot of the holdings and the bonds which are custodied. And so I don't really have any other comments unless you have questions. But it's been good.
Any other questions on the Capital City report?
I got a quick question in regards to the report. In reference to the yield, is that in regards to dividend yield or yield accrued through the investment itself?
Well, both. The yield is dividends and the income from the bonds and the rent income from the real estate. So 1.56 is the yield of the total, not counting the infrastructure.
Gotcha. And the dividends are just dripped back into the individual funds themselves?
No, they dripped into cash and then I reinvest them.
Thank you, sir.
Yep.
Motion to accept the Capital City Trust.
Motion made by Dowell to accept the Capital City Trust report.
Second.
Second by Lenity. All in favor? Aye.
Aye.
Motion passed. Ms. Jill, Ms. Sunny, maybe you can correct me if I'm wrong. Can I jump out of order and go to number 10 so we can re-elect this so Mr. Leary can?
No, because it has to go before the commission. After you approve of him, it still has to go in front of the commission.
From the commission. Okay, thank you.
If I may, good morning, everybody. Is it Mr. Leary hasn't been re-elected? Is that the issue?
Yes, he needs to get reelected here in this meeting. Then he'll go in front of the commission and get reelected, appointed there.
Okay, just so everybody knows, Florida is a holdover state. So that means that the trustee can, if he wants to, which it sounds like he does, can serve in his trustee position and participate in the meetings until he is reelected or the seat is filled by another trustee. So he's allowed to participate in the meeting today. Just so you all know.
Thank you. I appreciate it.
You're very
Yes, ma'am.
welcome.
Thank you. Next on the agenda is the Burgess Report.
Thank you, sir. Jill,
Yes.
do you mind putting up my report for those in Cyberland?
Yes, just one moment.
You all have the hard copy with you? Good. And by any chance, did it come with a supplement like this? Little piece like this? No? You should have. I'll make sure that you get it next time. If you would, please turn to page 15. And as Jill gets things going here. Patrick, you still online?
I am.
I thought you left already. I was fearful that you were not going to watch the report.
How could I not want to watch your report?
So I learned this trick from Patrick to jump around. So we're going to go to page 15. We're almost there. There you go. This is, sometimes I don't get a chance to talk about this one. It's important though, because it is giving you an indication of how well you're performing relative to your peer group, meaning other pension plans. And in our world, pension plan means defined benefit plans. And the four colors, slices of these bars represent quartiles. You really you don't want to be in the red zone, and you'd really like to be up in that purple zone, or certainly above the midpoint, which is where the green and yellow meet. That would be the median. But you can see that given the, I would say, moderately aggressive allocation, and I'll show you an illustration of that in a minute, the blue dot is spent most of the time above average, and more recently it's been certainly for the 1 year period, it was ranked in the top 20th percentile. So you're doing quite well. And if you look at how these other plans that you're being compared to, how they allocate their money, you're very different. For example, you're very US centric, US companies. Your peer group has a higher allocation to foreign stocks. You have no private equity, and your peer group has a pretty significant allocation to private equity. And you have no foreign bonds. So what's interesting is that the city of Palatka program has done so well, the firefighter program, yet it's very different from everybody else. And I would submit to you that if the allocations here were like everybody else, the results would be much lower. So Dwayne's doing a very good job here. Let me show you another slide, and that's on page 17. We do like to keep an idea of where the risk is, and one way we measure risk is exposure to, on page 17. Come in.
Yes.
There we go. Wait. Okay. So if you look at that blue square in we'll call the northeast area, and then compare that to the little plus sign in the left-hand lower left quadrant, that line that I call it the capital line sort of goes from one to the other. It missed a little bit below the square. And where you are, that dot in the middle is in between risk off, completely no risk, which is bonds. That's the plus sign. And the square represents risk on, or equities. So you're in between full risk and no risk. So that's why I would characterize this as moderately risky. And risk is also measured, not just from the standpoint of beta, but from the variability is measured by standard deviation. And you can see that's what's we're looking at from left to right is the variation or variability of historical returns. So that's a good sign. Risk is moderate and the rankings are very high. Well, that's okay, except how do we look in terms of returns long-term? Because this is what Patrick, when he wakes up at 2 a.m. in a sweat, he's worried about you not getting to 80% or better on the, so go to page 11 on the funding ratio. And you can see that over the last 10 years, gross of fees, the annualized return was 8.4% per year. And then if you go to page 13, that takes the fees into account and it shows an annualized 10-year number of 8%. What was our objective 10 years ago? For those of you who were here 10 years ago, it was 8%. So mission accomplished. That was the mission, the 65% allocation to equities. The modeling that was done by our office was designed specifically around that 8%. Now, while Patrick has indicated other factors that determine the funding ratio, this is certainly one of the most important factors.
That's really neat, Burgess.
Pardon?
That's really neat statistic there.
Yeah, thank you, Patrick. On page 8, these you can see the allocations relative to the policy. Dwayne's for quite a while has had an overweight to domestic equity. And I mentioned to you that earlier that you're quite different than your peer group because you are very domestic equity centric. We're underweighted in infrastructure slightly. The convertible bonds, which are really equities, the statute requires them to be treated as equities. And that's because there's an equity optionality that drives the returns. And just to give you a sense, the reason why the convertible index was up around 50% last year for the calendar year is because at one point Tesla represented about 15% of the index. So Tesla has done a lot of capital raising through the convertible spectrum, and because Tesla stock I think went up 300% last year at one point. I kind of lost track of it. Does that sound about right? More. As the common stock of Tesla went further and further into the stratosphere, it pulled up the convertibles of the index quite a bit. So that was one factor associated with that. The REITs, well, international, we have an underweight there. It really hasn't hurt you at all because domestic has really done better. The REITs had a terrible quarter last year, first quarter, and then really they made a remarkable comeback since then and continue to do so. So that's the story there. And then on page 7, look at the dollars. 10 years ago at this time, talking about 12/31, you had 5.9 million. A total of 2.4 million on a net basis has left the plan over that 10-year period. And that the positive side of that number is the Chapter 175 money, the payroll deductions that you make, and the city contribution. Those are the plus side. And then the negative side would be obviously expenses for retirees predominantly. And you made about 5.7 million over that time period. So yeah, you earned twice, more than twice what you spent on a net basis over the last 10 years. Patrick is the expert on the math, but looks pretty healthy to me. And you saw that chart, that bar chart he showed, the historical funding ratio has been fairly stable. And more recently, it looks like it's going to hit 80% here pretty soon. All right, we'll wrap it up here on page 4 with the summary. The model is a 65-35 model. We have some clients that are 72, 73% in equities. They're very aggressive. You're not like that. We have a number of passive strategies in place here to keep the costs down, and they've been very successful in keeping the costs down, which means it saves the city money, and it means really that the city's required contribution is lower because you're saving money on the expenses. 901,000 was earned for the quarter, 10.7% net. You see the 10.8 versus 10.7, there's a difference of 0.1. And so that gives you a sense of the expense ratio for the quarter. Ranking was very good, top 33rd percentile. And you can see small cap led the quarter at 31, big bounce back, followed by convertible bonds at 22%. Now for the year, you also did well. You ranked well, top 20th at 15.1%, which is admirable. And the best performer were the convertible bonds, thanks to Tesla and some other technology names. It was up 54%. Now you had an underweight there. Dwayne chose to be half weighted there, but still you got a lot of bang out of that 4% weight. The 3-year number and the 5-year, all of these are very good. He's doing a great job for you. That's all I have. And I hope to open it up for any additional questions.
Questions on the Burgess Chamber report?
Motion to accept the Burgess Chambers report.
Motion's been made by Dowell to accept the Burgess Chambers report.
Second.
Second by Lenity. All in favor?
Aye.
Aye. Motion accepted. I think I found the paper you're looking for there, Mr. Burgess.
Thank you. Oh, you do have them.
It was stuck in here.
Well, is there a motion? Did you finish the motion? All done? Well, I just wanted to, just for in your spare time, if you look at each of these are the funds that you have,
It's in this. Hang on.
and you can
It was
see what you
stuck in here.
own. So, for example, in the Vanguard Institutional Index, you can see the top 5 holdings: Apple, Microsoft, Amazon, Facebook, Tesla. Pretty good lineup. And you can see the rest of all the way down here. And in each of these, you can see what's embedded in each of these funds. Thank you.
Thank you. Next on the agenda is Ms. Harvey.
Good morning, everybody.
Morning.
The first item on the agenda is the proposed statement of policy regarding the contractual provisions for investment managers. Jill, are you able to pull that up?
Yes, I'll be pulling that up.
Thank you so much. I don't know if you all had an opportunity to review it yet, but essentially when we prepare these investment manager agreements, including the collective insurance trust that we were working on for you all, or that we're still working on for you all. These documents often reference board policies, and your board currently doesn't have any policy regarding these investment manager agreements. So what we did was we put together this proposed policy, which it's pretty long. And it talks about what we as a firm like to include in any side letters to these policies. And a side letter is just, it's a side agreement or a side contract to address issues that aren't already included in the primary contract. So for our purposes in the investment manager agreement documents that are sent over from the managers. There are several provisions that we like to include in these agreements. For instance, one is an acknowledgement that the investment manager will be a fiduciary to the plan, that they are investment managers as defined by ERISA. The board is not going to indemnify the investment manager or any third parties. The board doesn't waive sovereign immunity, so it retains all of its defenses and rights as a governmental plan. The board will seek most favored nations provisions, which just means that if the investment manager enters into any later contracts with other similar situated plans with relatively the same funding status and money in the account, that they will honor the agreement with your board, with your plan. Do we usually put Florida would be the governing law. So in the agreement that we are working with Sawgrass and Alta, their governing law is South Dakota. So that's one of the issues we're working on, is trying to get Florida, the governing law, and venue, which would be where, if there is a lawsuit, then it would be. So public records law, that's something that we have to put in all of our agreements, which is under Florida Statutes 119. The Sunshine Law, which just is that the boards are subject to open meetings. We have the provision for hiring or accepting a proposal for a bid from any company that's on the convicted vendor list. You can't, they are certifying that they're not on that list. And most recently, we have to add a provision for E-Verify, which is also on today's agenda, which is a law that went into effect January 1st of this year. And it says that all public employers are required to register with and use the free E-Verify system, which verifies the work status of all vendors that the board hires after January 1, 2020, and any subcontractors that that vendor may use. Let's see here. Payments would be in arrears for all of our investment manager agreements. The investment manager will provide the board with quarterly reports. And then we suggest that this policy be updated or at least reviewed within every 3 years. So I realize that was a lot of information. Is there any questions on side letters in general or the policy? Again, it is proposed. It's not something that the board has to adopt, but it's a good idea since all these investment manager contracts generally mention board policy.
Any questions?
If there are no questions and if the board is interested in adopting it, a motion would be in order. It could always be tabled if you all would like to take a closer look at it. Just let me know.
Seeing that we don't currently have a statement of policy regarding the contractual provisions for investment managers, I'm gonna go ahead and make the motion to accept.
Motion made by Dowell,
Second.
second by Lenity. All in favor?
Aye.
Aye.
Motion passes. Ms. Jill, is this going to require all trustees' signatures?
Yes, please. And then if Ms. Jill can forward it back to me for our records when it's been signed.
Okay, I will, before we leave today, I'll have one copy here. We'll all put our signature on it to speed that process up.
Thank you very much. The next item was the E-Verify, which we talked about briefly with the policy statement. So again, the board whichever vendors the board hires after January 1, 2020 has to register with this E-Verify system. The board itself has to, as a public entity, has to register with the E-Verify system as well. And the process, I don't think it's too terribly cumbersome, but if there's any questions, Ms. Jill can always reach out to our office. We can assist. Our office has already registered with E-Verify, and I'm sure Patrick's office is already registered, and Dwayne's, I'm not sure, but I'm sure he is. But this is moving forward. Is there any questions about E-Verify?
Questions?
No, ma'am, no questions.
Wonderful. Then the last item on the agenda, I think we may have gone a little bit out of order. The Sawgrass CIT agreement update. So that is the subscription agreement has been completed. That's relatively straightforward. It's the side letter that we're currently working on with Sawgrass and Alta. And that side letter is what we discussed in the policy that we just talked about. So we're trying to get those provisions added into the side letter and agreed upon for the board. I just reached out to them yesterday and I heard back today they are still reviewing it. It came back to us one time with some revisions and we accepted those revisions and now it's back in their hands for review. And that's the end of the attorney's report. Thank you.
Thank you.
You're very welcome.
You guys mind if I jump in for 1 second?
Yes, sir. Go ahead.
I just remembered that every year when you approve the valuation report, you're supposed to do this dumb exercise that the state mandated a long time ago, but you have to declare an expected investment return for the next year, the next several years, and the long term thereafter. And so I would recommend you just do that declaration with 7.5% because that's what's in our valuation report. So if someone could just make a motion that based on the advice of their consultants, the board expects to receive a 7.5% investment return for the next year, the next several years, and the long term thereafter.
Okay.
Motion to accept the 7.5% return.
Motion made by Dowell,
Second.
second by Lenity. All in favor? Aye.
And you do this every year, and I gather, Jill, do you put the letter together and send it off to Division of Retirement? You don't do it?
No, I haven't done that before.
Okay.
Well, I can help her.
I mean, my office is prepared to do it. I think. we've
Okay,
done
that'd be
it.
great. You guys are the investment people.
Okay, so my office will take care of the letter.
That's it for me.
Cassandra,
Yes.
since that declaration of expected return was made by the board and adopted by the board, should that letter, I'm happy to prepare the letter, but shouldn't that letter be on their letterhead and signed by the chair?
Yes. Yeah, you all can assist in adopting it and then Ms. Jill can get it, or you all can get it signed by the chair.
So Jill, I'll send it to you. All right, okay,
Sounds good.
thank you.
Thank you. Any other questions for Ms. Harvey?
No further questions at this time. Motion to accept the Harvey report.
I think we already did that. Yeah. Yes.
Sunny's telling me we don't have a quorum right now. If we could hold off making a motion.
Yes, we will. Ms. Shield, we already did the motion on the Ms. Harvey report, correct? Okay, awesome. Next on the agenda is expenditures. Everybody have a chance to review the expenditures?
Any questions regarding the expenditures report?
None heard.
Motion to accept the expenditures?
Motion made by Dowell to accept expenditure report.
Second.
Second by Lenny, all in favor?
Aye.
Aye, motion passed. Ms. Sunny, Ms. Jill, any public comments? Yes, ma'am. Thank you.
Sunny's checking. Public comment.
No public comments. As none being heard, we will move on to other business. Re-electing Mr. Leary as the 5th member.
Motion to re-elect Mr. Leary?
Motion has been made to re-elect Leary by Mr. Dowell.
Second.
Second, all in favor?
Aye.
Aye. Motion has passed to re-elect Art Leary as 5th member.
That's everything on the agenda.
That's everything on the agenda. Was there any other business?
No, sir.
Motion to adjourn.
Motion to adjourn by Lenny at 11:10.
Second that motion.
Second, motion has passed.